Good morning, good afternoon, good evening. My name is Market Maker 69420, and in this episode, we're going to go over the U.S. economic slowdown versus stock, crypto, and commodity market. As of February 2026, the U.S. economy is showing clear signs of deceleration in early 2026, with growth moderate after resilient 2025. Recent data indicates softening across multiple indicators, potentially signaling a broader cooldown amid policy uncertainty, including tariffs and fiscal shift. Let's analyze and look at some key reasons why. Looking at gross domestic product, or GDP, the advanced estimate for Q4 2025 GDP growth was 1.4% annualized, a sharp slowdown from 4.4% in Q3 2025. This aligns with weakened PMI data, suggesting further softening into Q1 2026, with analyzed growth potentially around 1.5%. The government shutdown in late 2025 subtracted about 1 percentage point from Q4 growth, but even adjusted, private demand remains solid yet cooling. When looking at employment and unemployment rate, January 2026 non-farm payrolls rose by 130,000, with gains in healthcare, social assistance, and construction offset by losses in federal government minus 327,000 since October 2024 and financial activities minus 49,000 since May 2025. The unemployment rate held at 4.3%, up from 4% a year ago, with 7.4 million unemployed. Average monthly growth in 2025 was just 15,000, indicating labor market cooling, including more part-time work for economic reasons and fewer job seekers. When looking at inflation metrics, CPI and PPI, CPI rose 0.2% in January 2026, seasonally adjusted, with a year-over-year increase of 2.4%, down from 2.7% in December 2025, reflecting continued disinflation. Core CPI, excluding food and energy, was up 0.3% monthly and 2.5% annually. Key drivers include shelter plus 3% and medical care plus 3.9%. PPI for final demand advanced 0.5% in December 2025, seasonally adjusted, with a 3% year-over-year rise, down from 3.5% in 2024, led by services plus 0.7%, while goods were flat. Trends show inflation easing, but with risks from tariffs potentially pushing it higher. When looking at consumer confidence and retail sales, the Consumer Confidence Index rose to 91.2 in February 2026, up from 89 in January, but remains below the 2024 peak of 112.8. The Present Situation Index fell to 120 amid worsening business views and inflation concerns, while expectations improved to 72. Retail sales data is mixed. Consumer spending supported Q4 2025 growth, but low confidence and high prices are stymieing future gains, with potential weakness amid lower income households. When looking at industrial production and manufacturing, industrial production rose 0.7% in January 2026, with manufacturing up 0.6%. However, capacity utilization is at 76.2%, 3.2 points below the long-run average, and manufacturing at 75.6%, 2.6 points below average, pointing to underutilized resources and a slowdown in global manufacturing. When looking at Federal Reserve policies and interest rates, the Fed cut rates by 1% in late 2024 and 0.75% in 2025, bringing the federal fund target to 3.5 to 3.75%. Median projections anticipate one more 0.25% cut in 2026, but markets expect 2 to 3 amid slowing growth. Recent FOMC minutes in January 2026 emphasized data-dependent easing, with concerns over sticky inflation and tariffs. Policy supports growth, but remains cautious. Overall, these indicators confirm a slowdown, with GDP and labor markets weakening, inflation moderating, and the Fed poised for limited easing. Risks include tariffs, debt, and policy uncertainty, potentially tilting growth lower. When looking on the effects of the stock market, slowing growth heightens uncertainty, pressuring equities through reduced consumer spending and business investment. However, resilient earnings and potential rate cuts provide offset, leading to sector rotation. When looking at corporate earnings and valuation, earnings growth is projected at 14.6% for 2026, led by tech, 32.3% up, but slowing GDP could erode this. Valuations are elevated, S&P 500 at 28x earnings versus small caps at 18x earnings, raising bubble risks, especially in AI stocks. High multiples historically led to muted returns. A slowdown may mask weakness in lower income-driven spending. When looking at interest rate sensitivity, higher for longer rates increase borrowing costs, hitting growth stocks harder, NASDAQ more volatile than Dow. If the Fed cuts more than expected, it could support rate-sensitive areas like small caps, which surged 5.4% in January versus S&P 1.5%. Slowing growth amplifies sensitivity, potentially delaying correction. When looking at sector impact, rotation from mega cap tech, Magnificent 7 plus 0.3% in January, to cyclical domestic sectors like small caps and aerospace/defense. Consumer discretionary underperformed due to job sensitivity, financials risk if unemployment rises, healthcare and utilities favored for defensiveness. AI exposed firms face de-risking amid high valuation. Overall, markets are resilient, Dow up recently while while Nasdaq falls, but a deeper slowdown could trigger correction. When looking at the effects on the commodities market, slowing U.S. growth dampers demand, differentiating cyclical from safe haven assets amid global tension. When looking at demand dynamics, reduced economic activity lowers demand for energy and industrials. Oil futures fell as global growth slows with surplus supply, 0.9 MBD demand growth versus threshold supply. Industrial metals range bound due to slow manufacturing. Tariffs could exacerbate deficits. When looking at safe haven versus cyclical assets, safe havens like gold surge, forecast 5,000 per ounce by Q4 2026 on diversification from US dollar and geopolitical risks. Silver and platinum follow. Cyclicals like oil face downward pressure, Brent $68 per barrel, up 10% year to date but off peak, with LNG prices falling on supply glut. When looking at currency and global factors, a cyclical US dollar decline due to slowing growth and relative Fed easing boosts commodity prices in US dollar. Trade tensions and supply shocks from the Middle East add volatility. EM central banks shift to gold reserves. Commodities are volatile, with safe havens outperforming amid uncertainty. When looking on the effects of the cryptocurrency market, as risk assets, cryptos are hit by reduced appetite in a slowdown, but adoption and liquidity shifts offer counterbalance. Looking at risk appetite, slowing growth and volatility from tariffs prompt de-risking, pressuring Bitcoin and Ethereum, recent drawdowns tied to AI/tech sell-offs and Fed uncertainty. Crypto correlates with equities during stress, with fear indices at capitulation level. When looking at interest rates and liquidity, higher for longer rates tighten conditions, reducing speculation. Delayed cuts from inflation weigh on prices. However, Fed easing historically boosts crypto. 500 to 1,000 days post cuts, 7.8 trillion in money market funds could rotate in. When looking at adoption and sentiment, ETF hype has faded, but with a resilient economy and wage growth support, stablecoin dominance rises as a safe haven. Positive drivers include digital asset treasuries and AI electricity demand, but structural issues like liquidity events cause sharp pullbacks. Crypto faces volatility, but rebounds if macro improves. That's all I got for you guys today. Don't forget to like, comment, and subscribe. And if you want to support the channel, feel free to buy me a coffee on Patreon. Bye-bye.